Welcome back, it's me Adam and you are watching Unlimited Options Investing. This was the craziest week in the market, and I know I say that quite often that this is going to be the craziest week or whatever, but for real this time, this was the craziest week for 2022. For starters, on Tuesday we had Microsoft and Google both report earnings. Ever since, both stocks are up quite big ever since they reported. Today we had Apple and Amazon report earnings for quarter two. And again, both stocks are popping after hours, and we're hitting some pretty key resistance points on the charts, as we'll see momentarily. Yesterday, the Fed had raised rates by 0.75% or 75 basis points, something they see as extraordinarily rare, as they claimed the first time they did it, and we've done it for a second time in a row now. And investors were contemplating whether they would see 0.75% or 1%, but we did see 0.75%. And today, GDP contracted for a second quarter in a row. So we're now unofficially in a recession, even though the White House will never say we are in one. And you have analysts from JPM claiming that we are nowhere near a recession. Crazy, confusing times, but the market has been rallying. Are we going to see a full-on recovery, or is this the fake out of our lifetimes? Let's take a look, especially at the technical analysis of things. If this is your first time on the channel, welcome aboard and hit that subscribe button. Smash that like button and take a look at my description for links to my Instagram, my TikTok, and my Twitter. So let's first off take a look at the SPY of the S&P 500, and after hours we are sitting at 408. So we were in a part of this channel where we were seeing higher lows and higher highs, and we are breaking out of that channel right now, testing a key resistance of about 410. So are we going to break 410? Next level will be 416. And at that point, we really could be on a full-on recovery mode. But just like we saw back in March of 2022 into April of 2022, we were well above the 200 simple moving day average, as well as both the 20 and the 50 exponential, just for it to turn right around at the end of March, just because it looks like we could be in the clear, filling in gaps that we had. Again, two major gaps back at the beginning of June. Doesn't necessarily mean that we are in the clear until we see sustained rally over the course of a few weeks to a couple of months. Likewise, if we take a look at the NASDAQ, this one is still in this channel. However, we are going to be testing the top of the channel starting tomorrow, as after hours, again, after Amazon and Apple have both reported, we are going to be testing that key area of resistance around $315 per share. So again, because we are at the top of this channel, are we going to see some kind of rejection? It is pretty likely that we do see a couple of steps back after seeing two pretty green candles in a row. When we look at the correlation of both the NASDAQ and the S&P 500, all these charts are looking pretty similar, but again, we are still in that channel. We haven't broken out of it just yet. After hours, again, we probably are at the top of this channel at 0.77 after closing on the day at 0.76. But as we saw a few days ago, we were above the channel just to get rejected and have three straight red candles in a row. So again, until we really break this 0.77, 0.78 area with conviction, and we're on our way toward the 200 simple moving day average, we can't say for sure that we are in the clear until we break out and don't retract back into the channel. If we take a look at the Dixie, the dollar index, so the US dollar compared to all the biggest currencies in the world, the euro, the Canadian dollar, the Japanese yen, the Chinese yuan, we see that we have been retracting from the 109 level. Currently at the 20 moving average, we want to see this 50 exponential break at about 105. If we do see continued weakness in the DXY, this could signify that those same dollars are being transferred into stocks and bonds and other assets. And if bonds are being bought up, that means that the yields are going to be brought down. So as we can see, the 10-year has been going down over the past few days. We are at an area, I guess, of support around 2.68, 2.7. And the 2-year yield, this one has been still showing a lot of strength. I think until we see numbers on the CPI convincingly show us that inflation is calming down, I think the 2-year will still remain elevated. But again, once we do see those numbers, I could see the 2-year easily going back down to 2% or 1.8 near that 200 simple moving day average. If we look at the volatility index, we have been climbing down ever since the middle of June when we were at 35, now approaching that 20 level at 22.32. And as Josh Brown says, when the VIX is around 30, 35, that's when you start adding to your stocks. And when we start going down below 25 toward 20, that's when you start selling off your stocks. So again, That's a trader mentality. If you want to do that for 2022, by all means. But again, being a buy and holder as I am, it doesn't matter whether the VIX is high or low. I'm just buying and accumulating my stock for the long term. When we look at the VXN, the Nasdaq 100 volatility, this has been swelling up since October of 2021. We had a resistance of about 43 on the volatility, and we finally look like we could be potentially breaking this uptrend. We were testing at 200 simple moving day average. However, we are still seeing weakness, so it may not necessarily hold up. And I drew this line of this uptrend and this resistance point that we had like an end date of November of this year. So we were going to know by the middle of November whether either we were going to see intense fear climb up above this resistance, or if we were going to break the uptrend. And I was hoping for the latter and that we would break it. And if we are able to break this area and go closer and closer to 20, where we were for a lot of 2021, we could see an extended rally in tech stocks and risk on assets. Looking at a few specific stocks, if we start off with Apple, this one had lows back in the middle of June at about $130 per share. We're now pushing up against that 200 simple moving day average, and after the earnings came out today, we're now actually above that 200 simple moving day average. So let's see if it can hold as support or if we're going to get faked out epically. If we take a look at next at Microsoft, the second biggest stock in the market, this one has fallen off a lot more than Apple stock, still well below its 200 simple moving day average. But after earnings came out and we saw about $250 per share, we have rocketed up to about $280 per share almost. Just in 2 trading days, we've seen 10% right into Microsoft, right at that area of resistance. So it wouldn't be out of the ordinary to see some kind of pullback after such a big rally up. Even Google, right at its earnings, was below its channel. If earnings were bad, we could have seen a lot more destruction. However, things weren't as bad as they were expected to be. So we saw a rally in the stock from about $105 a share to $115, sitting right in the middle of this channel. We want to see a break of 120 to see a full-on recovery toward about 125, where that previous support line, which is now going to be resistance. Meta stock near its 52-week low, and if we actually take a look at the weekly of this one and zoom out, we see this huge trend line, this uptrend that we had previous resistance back in 2016, 2018, 2020, and where we are currently. So even after these earnings, the stock did go down, but not too much, because again, it wants to hold the support line. If we break the support line, it could be really, really bad, but not a bad area to add onto Meta shares if you believe in the stock long term. I don't, but again, not a bad area or a bad trade. This one is going to see some recovery in the medium term. And lastly, also Amazon, which reported earnings today, is up quite big after hours, up almost to $140 per share after closing the day at $122. So this was a very interesting key area back earlier at the beginning of the year, where it was acting as support back in January and back in March and back in April, up until those earnings where things just plummeted down to about $100 per share. And then you had the split happen and everything back in June. We touched that 50 EMA and got rejected, and then we are now at a current key area, but we are above the 50 EMA, and then where we are after hours, we're right at that key area of 140. So let's see if we're able to hold up, or if we get rejected in epic fashion, similar to Apple and Microsoft. They're all going to move together. So just depending on sentiment, if we want to sell off and big money wants to sell off, all these stocks are going to see all their gains evaporate from the past couple of weeks. But if we want to see a continued sustained rally, we're going to see it happen across all these big tech names. And lastly, looking at Tesla, which reported last week, we have a gap over here that may or may not fill. So we gapped up, we retraced, we didn't necessarily fill the gap, but now we're seeing more strength, and the 20 and the 50 EMA are crossing over. So we're seeing a lot of strength and a lot of recovery for stocks at the moment, but is it going to sustain? Well, we'll just have to see. And lastly, I want to take a look at the correlation of XLK and RSP. XLK being the technology ETF and RSP being the S&P 500 equally weighted. So seeing how the XLK ETF is doing relative to the other sectors, and XLK and technology have been gaining, as we've been seeing with other correlations like QQQ to SPY. So today, after hours, we're currently almost at a correlation of 0.99, which is right next to that, again, 200 simple moving day average of 1. So if we're able to break this correlation of 1, this could be really strong for some prolonged recovery. But again, if we get faked out and we're unable to break this key level. So let me know in the comments below, do you think we're in full-on recovery mode? Are you skeptical like I am? or is this a clear on bear market rally and all the negative sentiment is going to come right back into the market? Let me know in the comments below. As always, subscribe and like, and I will see you guys in my next video.